All right, get ready, because today we're going to crack open the playbook on technical analysis.
I like that. A playbook.
Exactly. We're diving deep, and I mean deep, into Trading Technical Analysis Masterclass.
Oh, by Rolf, Schlotmann and Moritz Czubatinski.
You know it. And by the end of this, you'll be looking at those charts like, whoa, I never saw it that way before.
We're talking insights most books just kind of skip over, you know?
Okay, I'm already hooked. But before we get all lost in the charts, what even is trading, really? Beyond the whole buy low, sell high thing.
Yeah, good point. It's more about anticipating, like you're riding a wave, whether it's going up or down, you got to be ready.
So there's potential to make money even when the market's, like, tanking.
Exactly. Which is pretty awesome when you think about it.
Okay, that is cool. So how do we figure out which way that wave's going to go?
Well, there are two main schools of thought, right? You got your fundamental traders. They're all about the news and the numbers.
And then the technical traders, they're the ones who, like, live and breathe those charts.
Exactly. They believe all that news, all those emotions, it's all baked into the price action already.
And that's what we're going to focus on, becoming chart wizards.
Precisely. Now, even within technical analysis, there are different styles. Day trading, that's like sprinting, you're in and out of trades super fast.
High-intensity stuff. I'm more of a marathon runner myself, so swing trading, holding trades for days or weeks, that's more my style.
Yeah, swing trading gives you more flexibility. It's about identifying the bigger picture moves.
Sounds more like our deep dive style, right? Efficient learning for maximum impact.
I like it. But let's be honest, some people think charts are just, I don't know, random.
Yeah, like that whole dart-throwing monkey thing, right? Anyone can point at a chart and say buy or sell.
But here's the thing. Charts are actually visual representations of mass psychology, like millions of traders all feeling fear and greed.
So it's not random, it's the heartbeat of the market playing out in real time.
Exactly. And those emotions are timeless. Chart patterns from decades ago, they still work today.
Whoa, that's pretty mind-blowing. So it's human behavior that's the constant, even as the markets change.
Now, here's another layer to this, the self-fulfilling prophecy thing. Charts work because so many people believe in them.
Hold on, so if enough traders think a stock's going to go up, their actions can actually make it happen.
Yeah, it's the power of collective belief. Think of it like this. If everyone thinks a stock's going to crash after bad earnings, what happens?
They all start selling, driving the price down, making themselves right.
Exactly. So it's this feedback loop. Charts influence traders, and traders influence charts.
Okay, so technical analysis isn't just about reading charts. It's about understanding how those charts influence behavior.
Now, let's get into those charts themselves. First up, the language of candlesticks.
Candlesticks. Okay, now we're talking unlocking ancient trading secrets.
Well, they did come from 17th century Japan, but they're not that complicated. Basic line charts, they just show the closing prices, right?
Yeah, just a dot to dot. Kind of boring.
Candlesticks give you more information. You see the open, the high, the low, the close. It's like a whole story.
So it's more like a movie then, with those candlesticks showing us all the drama.
Each candlestick have a body and shadows. The body shows the open and closed price range. A long black body, that's sellers taking over.
Like a big wave wiping out the buyers.
And a long white body, that's the buyers pushing prices up. So yeah, those long bodies mean strong moves.
Got it. What are the shadows then?
Those thin lines above and below the body, they show the highs and lows reached during that time. Long shadows, that means there's uncertainty.
So it's like the price is testing the waters, trying to decide where to go.
Exactly. Now look at the relationship between the body and the shadows. Long body with tiny shadows, that's conviction, a decisive move.
And long shadows, small body, that's hesitation. Right?
You got it. Now these individual candlesticks, they form patterns. Like the pin bar, it's got a long shadow on one side, tiny body on the other.
It's like the market saying, nope, not going that way.
Exactly. Like if you see a pin bar after a big uptrend, that could be a warning sign.
That the sellers are stepping in, pushing prices back down.
So we've got these individual candlesticks, but how do we make sense of the whole chart, all that price action?
Right, it's a lot to take in.
That's where chart anatomy comes in. Charts, they have phases just like a story. Trends, corrections, consolidations, breakouts, reversals.
So there's a structure to it. It's not just random.
Right, it's the buyers and sellers battling it out over and over again.
And if we understand these phases, we can start to predict what might happen next.
A big, strong price wave that shows momentum, everyone's on board. But a bunch of little choppy waves, that's hesitation.
So the size and shape of the move matters just as much as the direction.
Now, within those phases, you've got swing points, the highs and lows. A healthy uptrend will make higher highs and higher lows, like steps.
Okay, so those swing points are like milestones on the market's journey.
And if an uptrend can't make a new higher high, that's a warning sign. Maybe the party's over.
Okay, so we've got candlesticks, phases, swing points, starting to see how it all fits together. But what about those, like, famous chart patterns? Head and shoulders, cup and handle, are those just shapes?
They're more than shapes. They show the psychology. That's what separates the pros from everyone else.
So just blindly following those patterns without understanding why could be dangerous.
Like trying to speak a language by just memorizing phrases, you need the grammar.
Okay, so how do we understand the why behind those patterns?
Let's start with the head and shoulders, a classic reversal pattern. The market gets tired, ready to change direction.
So how does that tiredness actually look on a chart?
You'll see three peaks, the left shoulder, the head, and the right shoulder. Head's the highest, and there's a neckline connecting the lows.
That neckline acts as support.
Right, and when it breaks, that signals the reversal.
Like all that selling pressure that was building up, it finally breaks free.
Now, here's the thing. The size and shape of those shoulders and that head, they tell a story. Small head, weak shoulders, maybe the reversal won't be so strong.
So we're looking for those little details the market's whispering to us.
And then sometimes you have a retest. After the neckline breaks, the price bounces back up for a bit, like a final shakeout.
A second chance to get in or out, depending on what you're doing.
Let's talk about another classic pattern, the double top.
That's when the price hits a certain level twice, but can't break through.
Exactly. It's like the market saying, nope, we're not going higher than this.
So that's a bearish signal, meaning the price might go down.
It often happens at the end of a big uptrend, so yeah, worth paying attention to.
And we're watching for that second rejection at the top. That's the confirmation.
Now, the opposite of the double top is the double bottom. Same idea, but bullish, the price can't break down.
So two failed attempts to go lower, creating support.
And those double bottoms, they often mark big trend changes too.
So we've got these reversal patterns, head and shoulders, double tops and bottoms. What about continuation patterns then, the ones that say keep going?
One of the most famous is the cup and handle. Forms during an uptrend, looks just like it sounds, a cup with a handle.
The cup is that rounded bottom, and the handle is a little dip before the price takes off again.
That handle is like a pause, the weak hands get shaken out, then the uptrend resumes.
So it's like a pit stop, time to refuel before the next leg of the race.
Another bullish one is the ascending triangle. Flat top, upward sloping bottom, like pressure building up.
The buyers are pushing higher, but there's resistance holding them back.
And then, boom, break out above the top line, the uptrend keeps going.
All right, so we've got these patterns, reversal, and continuation, starting to see how they give us a roadmap for the market.
And it's not just about the shapes, remember, it's the psychology behind them. That's the real power of chart analysis.
Because those patterns are like timeless, right?
Mhm.
Reflections of how people act, repeating over and over.
Now, there's one more big idea before we wrap this part up. Confluence, one of the most powerful things in technical analysis.
Confluence. I've heard that term before. It's when multiple signals all point in the same direction, right?
Yeah.
Making a trade more likely to work out.
But like having multiple witnesses to a crime, your case is stronger.
So instead of relying on just one thing, we're looking for that, like convergence of evidence.
Let's say you have a breakout from an ascending triangle happening right at a resistance level, volume is surging, and there's a bullish candlestick pattern. Boom, confluence.
It's like the market's shouting at us, no way to misinterpret it.
That's the power of confluence. We filter out the fake signals and find those high probability setups.
Okay, I'm already seeing how all these pieces fit together. Confluence, that sounds like the key to finding those winning trades.
It's a game changer, no doubt about it. Get ready, because we're going to take your chart analysis skills to a whole new level in the next part.
Sounds like a good place to leave our listeners wanting more. We'll be right back, diving even deeper into Trading Technical Analysis Masterclass. All right, deep divers, welcome back. Ready to unlock those high probability trades?
Confluence, that's where the magic happens, when everything just clicks into place.
It's like solving a puzzle. You know, all those pieces coming together.
Now, remember those moving averages we talked about? They're more than just lines on a chart. They're like the pulse of the market.
Yeah, those EMAs and SMAs smoothing out the price action, showing us the trend.
Right. And think about those commonly used ones, like the 50, the 100, the 200 period. So many traders watch those.
They become almost like self-fulfilling prophecies, right?
Mm.
Traders expect support or resistance at those levels.
Exactly. So their actions actually create it. Those moving averages, they're like magnets for the price.
Especially those longer-term ones, right? They're not just technical, they're psychological.
A bounce off the 200-day moving average, that might be a whole bunch of traders all deciding to buy.
It's that confluence of technicals and psychology we're talking about.
Let's talk about another tool, the RSI, The relative strength index.
Okay, the RSI. It measures momentum, right? 0 to 100, overbought above 70, oversold below 30.
You got it. But those levels, they're not magic triggers. More like early warnings.
A stock can stay overbought for a while if the momentum's strong.
Like a car going 100 miles per hour. It's not going to crash immediately, but,
Not sustainable.
So how do we use the RSI? Look for divergences.
Divergences. When the price and the indicator don't match, like price making higher highs, but RSI is making lower highs.
Exactly. Momentum's fading, even if it looks bullish.
Like that car, it's sputtering, even though it's still moving forward.
The RSI, it's giving us a heads up. Something's changing.
Okay, so we got the RSI. What about the stochastic oscillator? That's similar, right?
The stochastic focuses on where the closing price is within the recent price range. Closing price near the high, strong buying pressure.
Like a sprinter finishing strong.
Just like the RSI, look for those divergences with the stochastic.
Okay, so those are our momentum indicators, RSI and stochastic. What about those Bollinger Bands? They always look so interesting on the charts.
They are. Bollinger Bands, they expand and contract with volatility like they're breathing.
Wider bands, more volatility. Narrower bands, less volatility. They're like showing us the market's mood swings.
And traders use them for all sorts of things. Breakouts, stop-loss orders.
I've heard those breakouts from Bollinger Bands can be powerful signals.
They can be. But just like any signal, you need confirmation. Don't just buy or sell because the price touched a band.
Look for those other clues. The volume, the momentum, candlestick patterns.
It's about putting the puzzle together.
Right. Speaking of things we've talked about, support and resistance, those are important, right?
Those battle lines on the chart, yeah. Think of them as price levels where the market has memory. Past battles, they influence how traders react now.
So if a price bounced off a certain level before, it might do it again.
Exactly, psychological barriers. And here's the thing, the more a level is tested, the weaker it gets.
Like a wall getting chipped away at until it finally breaks.
And that's why breakouts are so important to watch. Support breaks turns into resistance. Resistance breaks turns into support.
It's like they switch roles.
Now there's also order absorption. Each time the price gets near a support or resistance level, traders are placing orders there.
So there's like this buildup of energy waiting to be released.
Until finally, boom, breakout.
It's supply and demand at work.
And that brings us to, you guessed it, supply and demand zones.
Supply and demand, I remember that from like econ class. How does that apply to charts?
Same principle. Supply zones, selling pressure outweighs buying. Demand zones, buying pressure wins. When price enters these zones, you get those fast moves, almost straight up or down.
So they're like compressed springs waiting to unwind.
Now the thing is, these zones aren't always obvious. You got to train your eye. Look for strong breakouts, timely breakouts, moderate volatility within the zone.
It's like detective work finding those clues.
Pro tip, those zones often form around those key levels we talked about: support, resistance, double tops, double bottoms.
How connected.
Confluence again. Now back to those chart patterns. It's not enough to just know the shapes, got to understand the why.
The market's telling us a story, right? Each pattern has a beginning, a middle, and end.
Head and shoulders, remember that's a reversal pattern. Uptrend might be turning into a downtrend.
The market's reaching a peak, getting tired.
That left shoulder, that's the initial push higher, but then they hit resistance, forming the head. They try again, right shoulder, but can't reach as high.
They're losing steam.
The neckline, that's the support. When it breaks, the selling pressure takes over.
Head and shoulders is about those failed attempts to make new highs.
Double top and double bottom, they're similar, testing those key levels. Double top, 2 failed attempts to break above resistance, that wall we talked about.
Like the bulls are charging, but they can't break through.
Second failure, that's the confirmation. Sellers are in control.
Double bottom, same thing but opposite. 2 failed attempts to break down.
Exactly. Like the bears are trying to get in, but they can't. Second failure, potential reversal to the upside.
Both patterns. It's about those failed breakouts, the power shifting back and forth.
Now for those continuation patterns, the ones that say, the story's not over yet.
What are those all about?
Existing trend is likely to continue like a pause for breath.
Pit stop in a race. Got to refuel.
Cup and handle, one of the classics. Consolidation during an uptrend. Cup, the rounded bottom, weak hands getting shaken out.
Handle, the little pullback, final shakeout before the breakout.
That handle's important. The market's coiling up, getting ready.
Cup and handle, shaking out the weak hands, the uptrend keeps going.
Ascending triangle, remember that one? Flat top, upward sloping bottom, that pressure building.
The buyers are in control, but there's resistance.
Triangle gets tighter, the pressure builds. Then The breakout.
Buyers win the battle. The uptrend resumes. Cup and handle, ascending triangle. It's all about that pause, that consolidation.
Not just the shapes, remember, the psychology behind them. Cup and handle, shaking out the weak hands, building up buying pressure, ascending triangle, that tension building, then release.
Okay, seeing those patterns as like human behavior playing out on the chart.
Now, before we go on, we got to talk about traps.
Traps. Uh-oh. Sounds dangerous. Like in video games, you lose all your progress.
They can be costly. The market looks like it's going to do one thing, then suddenly reverses.
Like a fake out in basketball. You think they're going one way, then they go the other.
They often form around those key levels we talked about. Support, resistance, double tops, double bottoms.
So those breakouts can be fake, designed to trick us.
Professional traders, they know how to set those traps.
So how do we avoid falling into those traps? What are the secrets?
Don't chase those extended moves. When a stock's gone way up, it's probably due for a pullback.
Be patient. Wait for the pullback before jumping in.
And wait for confirmation before you enter a trade. Don't just buy because the price went above resistance. Wait for it to really break through.
Look for conviction, not just a quick touch.
Understand those classic trap setups. Learn to recognize the patterns that come before those reversals.
Know the enemy's playbook.
Fake breakout, that's a common one. Price breaks above resistance, everyone buys. Then it reverses, traps all those buyers.
Little traps and bear traps.
Dead cat bounce, another one. Brief rally after a big drop makes you think the worst is over.
False hope.
Patience, confirmation, pattern recognition. That's how you avoid traps. Study the setups. Learn to anticipate. Don't let your emotions get in the way.
So much information, candlesticks, chart patterns, traps. Feeling like a chart analysis pro already.
Technical analysis is a journey, always more to learn.
The more you know, the more you realize you don't know.
Keeps it exciting. Now, let's talk about some indicators that can help you even more.
Indicators? Okay. I hear some people love them, some people hate them. What's the truth?
They're tools, not magic. They can be really useful if you use them right, but they're not the answer on their own.
Don't just blindly follow them.
3 main types: momentum, trend, volatility. Each tells you something different.
Momentum, like RSI and Stochastic. Tell us how strong the price is moving.
Trend, like moving averages, show us the direction. Volatility, like Bollinger Bands, show us how much the prices fluctuate.
Like a dashboard with all these different gauges.
Now, let's talk about the MACD, the moving average convergence divergence.
MACD. Sounds complicated.
Don't worry, it's not that bad. It's a momentum and trend indicator. Uses 2 moving averages to signal buy and sell signals.
Combines those two things we talked about.
Look for the crossover of the 2 lines. Bullish crossover. Faster MACD line crosses above the slower one. Potential buy signal.
Watching for those momentum shifts.
Now the MACD can also show divergences, just like RSI and Stochastic. Those can be warnings. Trend might be reversing.
Looking for those mismatches.
Bollinger Bands, remember those? Dynamic bands that adjust to volatility, widen when volatility's high, narrow when it's low.
Like a flexible envelope for the price.
Watch for breakouts with Bollinger Bands. Price breaks out could be a big move.
Breakout above the upper band, uptrend continues. Breakout below the lower band, downtrend continues.
But remember, need confirmation. Volume, momentum, candlestick patterns.
Confluence again.
RSI, Relative Strength Index, measures how strong recent price changes are.
Like a speedometer, tells us how fast the price is moving.
Those overbought and oversold levels, they're not trading triggers, they're warnings.
RSI, it's about the strength of the move, not just the direction.
Stochastic oscillator, similar to RSI, but focuses on where the closing price is within the recent price range.
High stochastic, strong buying pressure. Low stochastic, strong selling pressure. Look for divergences with the stochastic too.
Okay, we've covered momentum, trend, volatility indicators. They're tools, not magic. Use them to confirm your analysis, not to blindly follow.
Right, integrate them into our trading plan.
Now, last but not least, risk management.
Risk management, yeah, it's important, but it's not always the most fun to talk about.
I know, but it's essential. Without it, even the best technical analysis won't save you.
It's like having a seatbelt in a race car. You can be a great driver, but you still need that protection.
First principle of risk management, define your risk tolerance. How much are you willing to lose on a trade?
Set a limit before I even enter the trade.
Absolutely. And that limit should be a percentage of your account, not a dollar amount. Most pros risk less than 1% on any single trade.
So if I have a $10,000 account, I shouldn't risk more than $100.
Good rule of thumb. Risk isn't just about the percentage, it's about your emotional tolerance too.
If a 1% loss makes me panic, maybe I need to risk even less.
Find that balance where you can trade with a clear head.
Defining risk tolerance, that's the first step. Then what?
Next, determine your position size. How many shares or contracts are you going to trade? This is where your risk tolerance becomes a real number.
Like deciding how much fuel to put in the car for the race.
Make sure your potential loss on the trade doesn't exceed your risk limit.
So position sizing is all about aligning my trade size with my risk tolerance.
Third pillar of risk management, stop-loss orders. These orders automatically sell your position if the price drops too much.
They're like guardrails, preventing me from falling too far.
They take the emotion out of trading, especially important when you can't watch the market all the time.
But how do I set those stop-loss orders? Don't want to get stopped out of a winning trade too early.
It's about balance. Set your stop-loss below a recent swing low or a key support level. Give your trade room to breathe.
Support and resistance levels, important again.
Bollinger Bands can also help. Set your stop-loss just outside the lower band.
Okay, stop-loss orders are essential. Anything else?
Have a trading plan. This plan outlines your entry and exit criteria, your risk management rules, your overall strategy.
It's like a roadmap for my trading.
Helps you stay disciplined, avoid impulsive decisions, and manage your emotions.
Emotions can be dangerous for traders.
Fear and greed can cloud your judgment. A trading plan helps you stay objective, stick to your rules.
It's like a set of guidelines, keeps me on track.
Fifth and final principle, keep a trading journal. Track your trades, your wins, your losses, and the lessons you learned.
Like a diary for my trading helps me learn and grow.
Helps you identify your strengths and weaknesses, improve your strategy, track your progress.
Risk management, it's not just about protecting capital, it's about developing good habits for long-term success.
Taking responsibility for your trades, understanding your psychology, always trying to get better.
So much great information about technical analysis in this deep dive. Candlesticks, chart patterns, indicators, risk management.
Remember, technical analysis is just one part of it. Combine those technical skills with the right mindset, discipline, and always be learning.
Respect the market, understand it, and navigate it with confidence.
And you'll be on your way to reaching your trading goals.
All right. Deep divers back for more charting wisdom, I hope.
Gotta equip you with the tools to really make this work for you.
And speaking of tools, I think there's one we haven't talked about enough yet, one that can really make or break a trader.
Yes, risk management.
Not always the most exciting topic, I'll admit.
Yeah, right. But trust me, it's crucial.
It's like what they say, technical analysis helps you navigate the markets, but risk management, that keeps you from sinking.
Love that analogy. Because you can know all the charts, all the patterns, but...
If you don't manage your risk, you're going to blow up your account.
Exactly. So where do we even start with this whole risk management thing?
It feels kind of overwhelming, to be honest.
First things first, and this is so important, you got to define your risk tolerance.
Okay, so before I even think about what trade I want to take, I need to figure out how much I'm willing to lose.
Exactly. It's about setting those limits, protecting your hard-earned capital. Think of it this way. Most pros risk less than 1% of their account on any single trade.
Less than 1%? Really? That seems so tiny.
It might seem small, but it makes a huge difference. Look, if you risk 10% and lose, you need an 11% gain just to get back to even.
It's a lot, yeah.
But if you risk 1%, you only need a tiny gain to recover.
So it's about preserving capital, not going for those home runs that could wipe you out.
And here's something else to think about. Your risk tolerance isn't just about the numbers, it's about your emotions, too.
You mean like, if I lose 1% and I totally freak out, that's a sign my risk tolerance is actually lower.
Exactly. You need to find that level where you can trade with a clear head, not letting fear and greed control your decisions.
Okay, defining risk tolerance. Step 1, what's next?
Now you figure out your position size. Basically, how many shares or contracts are you actually going to trade?
Okay, so that's where the rubber meets the road, taking that risk tolerance and turning it into, I don't know, an actual number of shares.
And there are formulas for this, but the bottom line is make sure your potential loss on the trade doesn't go over your risk limit.
Like, if my account's $10,000 and I'm risking 1%, the most I can lose on a trade is $100.
Exactly. Then you use that to figure out how many shares to buy or sell, depending on the start price and your stop loss level, which we'll talk about in a sec.
Position sizing. All about aligning your trades with your risk comfort level. Got it.
Now, the third pillar of risk management, this one's a biggie. Stop loss orders.
Stop losses. I've heard of these. They automatically sell your position if the price drops too far, right?
Exactly. Think of them like guardrails on a mountain road that keep you from going over the edge.
So they take the emotion out of it, because if the trade's going against me and I'm panicking,
They make sure you get out before the losses get really big.
Especially helpful if I can't watch the market 24/7.
Exactly. They're working for you even when you're sleeping.
But how do I set those stop losses the right way? It seems tricky, like you don't want to get out of a winning trade too early, but
It is a balancing act. A common approach is to set it just below a recent swing low or a key support level. Give the trade some room to move.
so those support and resistance levels we talked about, they come into play again.
You can also use Bollinger Bands to help you. You might set your stop just outside that lower band, give it a little buffer.
So many ways to use those bands. Okay, stop losses, super important. Got it. What else?
Having a solid trading plan, this is like your rule book. It outlines everything.
Entry, exit, risk management, the whole 9 yards.
Helps you stay disciplined, not making decisions in the heat of the moment.
Because when those emotions kick in, that's when the bad decisions happen.
Fear and greed, they can really mess with your head. A trading plan helps you stay calm, make rational choices.
It's like a compass. Keeps you pointed in the right direction.
Love that. And finally, the fifth piece of the risk management puzzle. Keep a trading journal.
So, like a diary for my trades.
It's more than just tracking your wins and losses, though. It's about recording the lessons you learn along the way.
So I can go back and see why I made certain decisions, what worked, what didn't.
Exactly. Helps you figure out your strengths, your weaknesses, how to improve your strategy. It's all about continuous improvement.
So risk management, it's not just about protecting your money. It's about, like, building good habits as a trader.
Taking ownership of your trades, understanding your own psychology, and always looking for ways to get better. That's what it's all about.
Wow, we've covered so much ground in this deep dive, from basic candlesticks all the way to, like, advanced risk management.
And remember, technical analysis is just one piece of the puzzle. It's about combining these skills with the right mindset, the discipline, and always being open to learning new things.
Respect the market, understand how it works, and you'll be able to navigate it with confidence.
Absolutely. And with that, I think you're well on your way to reaching your trading goals.
This has been an awesome deep dive into Trading Technical Analysis Masterclass. I hope everyone's enjoyed it as much as I have. And remember, the real journey starts now as you take these tools and put them into action.
May your trades be profitable and your charts clear.
Happy trading, everyone. And until next time, keep exploring, keep learning, and keep diving deeper into the markets.